Hello everyone, how are you all? I'm Dr. Labib from Dr. Labib Academy. Welcome you all back. This is with respect to ACCA SBR. Okay. Chapter 5. We are continuing this chapter 5. Okay, non-current assets. Till the last session we have covered with respect to IAS 16 and IAS 20. Now we are continuing with the IAS 23 borrowing cost. This is in the series. This is the 10th one. Okay, this is the 10th one. That's very important. Okay, which one is? See, go by the sequence. You will not get confused as such. Just for your understanding, 10 by 25. I will change this to 25 as per my requirement, but the most important thing is 10. Coming back to this, what we are going to cover is, right? See, whenever we purchase a property, IAS 16 property, plant and equipment, definitely we will borrow loan. Okay, we will borrow loan, and plus it's not like that only the loan amount that matters, is it right? We will also have a element of interest will be there. Is that element of interest will be there? Now we have to make sure that how much amount. See, you have to divide it into two specific ones. Is right? The first one is pre-operative. The second one is post-operative. Okay. The second one is pre-operative expenses has to be capitalized, and post-operative operative should be expensed. Okay, this much if you have the clarity, it is more than enough for us. Is it right? Which you have what is the amount should be capitalized and what should be the amount to be expensed. This is what it has been given in IAS 23 with respect to borrowing cost. Now, when we do the things, what it says, borrowing cost is defined as an interest and other cost that any entity incurs in connection with the borrowing of the funds. Means you will interest and other cost. You may give some the things with respect to commission will be there. Is that processing fees will be there? Fine. Processing fee of the applications will be there. You will have some legal fees will be there. Whatever the fees attached to that borrowings, is that we have to identify it in connection with the borrowing of the funds. This is what the IAS para 5 will say. Borrowing costs should be capitalized very, very clearly if they relate to the acquisition, if related to the construction, or it is related to the production of the qualifying asset. Means we have to capitalize the borrowing cost if it is related to acquisition, point number 1, it is related to construction, or it is related to production. IAS 23 defines what is the qualifying assets. It will take a substantial period of time to get ready for its intended use or sale. Is it? It takes time. See, when you are talking in terms of construction, it takes time. Is it? When you are talking in terms of production, it will take time. It's not like that instantly, spontaneously. It will happen. Fine. Now, this is very important. Okay, they will test us. Now, capitalize. What is the capitalization period? When it has to be capitalized, when it should not be capitalized. There is a very, very clear instructions has been given. Is it? We have done this in F7 financial reporting. Okay, in F7 we have done financial reporting. The same concept. Now it is an extension of that. Borrowing cost can only be capitalized when it is in progress. Capitalization of borrowing should commence when all the things will. What will happen? When the expenditure of the asset is been incurred, borrowing cost are being incurred, and whatever activities are necessary, ready to use for this is in progress. Means once we have started this, automatically before it is going to be finished off, is it right? This period is entirely in terms of work in progress. Means you are getting the required machinery, your installation, you are in progress, is it? That amount has to be kept separately. In simple words, it is a pre-operative cost. Capitalization should cease when you have to stop, when substantial all the activities that are necessary to get the asset ready to use to complete. The moment we say that it is done, the process has been over, and we can use the asset, is it right? We can get ready for the use of the asset. Immediately we have to draw the line. We have to draw the line. Now what happens? Capitalization of borrowing should be suspended during the extended periods, which active development means. What happens? You have started in the month of January. It has been done till the month of May, but due to some conditions, for next 2 months, the things has been stopped because of some reasons. Again, May, June, July. Again from August it will start. Means when the things are not in process, we should not take the borrowing cost into consideration. This is the very important point, and this will be shown in the understanding also. So what are the specific and general borrowings? When a loan is taken out specifically to finance construction of asset, it has to be capitalized. The amount to be capitalized is the interest payable on that loan less income earned on temporary investment. See what happens, how the things will progress practically. You have taken a loan of $100,000. Okay, this loan, we are taken the loan has been sanctioned. Immediately what will happen? This we have done in financial reporting, if you remember rightly. Okay, what will happen? This will take place for the next 2 years. Assume, okay, next 2 years, and definitely you are not going to have the entire usage of the amount at once. Assume the amount at every phase $5,000 has been used. Okay, every phase $5,000. Now what people see, we are finance managers, is it right? What you will do, you will deposit this amount, is it right, for the next 2 years. Is it for the next 2 years? And what you will do, you will deposit the things taking into the timeline. Okay, taking into the timeline when we require this amount. Assume we require it on a quarterly basis. Then what you will do, you will make sure that quarterly basis for 2 years. It means it will come to how much? For 8 quarters. Is it right? 12,500. Okay, 8 quarters. 100,000 divided by 8. It comes to how much? 12,500. Is it right? Yes. Now what you will do? You will say 12,500. You will make a deposits for every quarterly. Definitely you will get interest on this. At least what will happen? The financial burden, is that the financial burden will be little bit reduced. Okay, little bit. Whatever you are making the investments, on that investment what will have? You will earn interest. Is right? You will earn interest. This interest will be used to pay off your interest expenses. Is it right? So that at least the gap will be reduced. That is what it says. The capitalized is the interest payable on that loan less income earned on the temporary investment of the borrowing. So if construction of the qualifying asset is financed from general borrowings, if the first one is for specific borrowings, the second one is general the borrowing cost eligible to be capitalized is determined by the weighted average general borrowing rate. Means what is the rate of interest we will calculate. Is that definitely? If it is general borrowing, means you will have a pool of assets and pool of borrowings, and from that we will take. We cannot take. We will take the average. Okay, means assume you are borrowing different in different terms. Okay, then you will take the rate of average rate. What is the disclosure? What it says? Disclosures are very important. Take my word. Okay, the value of borrowing cost capitalized during the period. Fine. This is where we have to make the period the capitalization rate as such. Fine. Now test your understanding. See, if you make it a point, you understand, test your understanding. 30% our concept is very clear. On January 1st, is it? On January 1st, 2001, High Rise obtained a planning permission to build a new office building. Construction has been commenced on 1st March 2001. Okay, to help fund the cost of building. How much is the loan? Loan is 5 million. Was taken out from the bank. When they have taken? They have taken it on April 2001. The rate of interest is how much? The rate of interest is 10%. Construction of the building was ceased. See the thing. January 1st, 1st March, 1st April, and on 1st of July. Is it right? I will write like this. Is it right? This is January 1. Okay? This is January 1. And from January 1 till you have 1st of March. Okay? 1st of March. And again, it is a 1st of April. Okay? It is the 1st of April. And from 1st of July, the construction for the building ceased. Ceased means it has been stopped during the holded it for the month of July due to an expected shortage of vehicle. Now what? By December 31st, fine, December 31st, the building was not complete. Is it? The building was not complete. Cost incurred to date is how much? 12 million. Is it? Cost incurred to date is how much? Now we have to make sure that in total how much is there when the construction commenced on 1st March. The building a loan was taken from the bank on from 1st April till 31st March. Okay, April, May, June, July, August, September, October, November, December. 9 months. Is it? How many months? 9 months. Out of this 9 months, month of July, is it right? Month of July should be deducted. Is it right? Means total will be how many months? Total will be 8 months. Is it? How many months are there? Total will be 8 months. Now, what will happen? What is the borrowing cost? Is it? You have to take the borrowing cost. Define. We have to take the borrowing cost for 8 months only. Okay, what is the loan amount? Loan amount is 12 million. Is it? Loan amount is 12 million. How much is loan amount is how much? Loan amount is what is there? Cost incurred to date was how much? 12 billion. Okay, loan amount is how much? Loan amount is 5 million. Okay, loan amount is how much? Loan amount is 5 million. 5 million. Okay, 5 million. What is the rate of interest? 10%. And for how many months? 8 by 12. Is it right? 5 times 0.1 times 8 divided by 12. It comes to how much? It comes to 333. Is it? Now it has to be added. How much? What is the cost incurred to date? Cost incurred to date. Cost incurred to date. Is it right? This is step 1. Okay. This is step 1. Fine. And this is step 2. Fine. This is step 2. Cost incurred to date is 12 million. Okay. Cost incurred to date is 12 million. Borrowing cost is how much? Borrowing cost is 33,333. Total cost is how much? Is it right? Total cost. What is what we have to write to this? This is the carrying amount. Is it? This is the carrying amount as on 31st December 2001. Fine. It's very simple. Okay, very simple. We'll do the things. This is the first one. Which one? IAS 23. The second one, what you are doing, we are talking about investment property. Another very, very important standard, IAS 40. Is it? IAS 40. What it says, what is the investment property? Most important thing is students will get confused here. It happens in F7, it happens in SBR. Investment property. The students who have done F7, financial reporting, they have much more clarity. Okay. What is investment property? Relates to the property held by the owner or by the lessee as a right of use of the asset to earn rentals, or for either you are doing it for a you are going to earn rentals, or you are having an expectations of what? Capital appreciation, or is both. Say this very simple words. Investment is you are having buildings, is it right? When you have the building, definitely you will get rental amount from that, plus automatically the value of the land will increase. Because of that, the value of the buildings will also increase. Is it right? You have to make it separately, what is the land and building. But we are not talking about the things in that much detail. Is it? See the thing. Examples of investment property: land held for appreciation, land held for future use, buildings leased out on the operating lease for a short term. Is it? These are the examples with respect to the investment property. And we have to make what are the things which are not going to be included. Property held used for the any production. See the thing. If it is held for any production of goods and services, it is comes under the category of property, plant and equipment. Okay, it comes under the property, plant and equipment. Whereas if it is held for ordinary course of business in the process of construction or development of such, then it is going to be called, which standard we have to apply? IAS 2. Here we are getting a very comprehensive understanding about various different standards, where IAS 16 is applicable, where IAS 2 is applicable. Property constructed or developed on behalf of third parties, it is going to be governed as IFRS 15. These are the things are not included in investment property. Owner occupied properties 16. Is it? We will do this again and again. Okay. Property leased to another entity under financial lease. If it is given for a financial lease, it comes under IFRS 16. Fine. Means you have to be very specific which are the things which are not included. I will write for your information IAS 16, IAS 2, is it right? IFRS 15. Okay. IAS 16 also applies with respect to owner occupied property, and IFRS 16. These are the standards within the framework is not going to be called as a investment property. Fine. How we are going to measure? Same thing. One is with respect to cost model and one is with respect to fair value. What is the cost model? We are not going to do anything different. Investment properties are held at cost less accumulated depreciation. If it is cost model, we have to calculate depreciation. If it is a fair value model, it has, see what are the fair value models? Very specific rules. No depreciation is charged, okay? And it has to be done each year. You have to value it at the end of each year. All the gains on revaluation should be reported to profit and loss account. These are the general framework with respect to the fair value model. In exceptional cases, if it is impossible to have a fair value, then the cost model should be adopted. What are the things? See, first thing is it has to value on each year. There should not be any depreciation. Anything should be treated to the statement of profit and loss account. And if it is very difficulty, then you have to use the cost model. What it says, there are 4 different conditions. Transfers to or from investment. See, it happens. You are transferring from investor to owner occupied to inventory to the to investment property. As such, you will do left, right, and center. Transfers to or from investment can only be made if there is a change of use. Okay, this is very the basic condition. If there is a change of use, there are several possible situations in which this might occur, and accounting treatment for each is set up. What is there? If it is transfer from investment to owner property, use the fair value at the date of change. Fine. If it is going to be changed from the investment to the owner's occupied property, okay, then it has to be done on transfer from investment to ownership. Definitely, it is a fair value at the date of change for subsequent accounting under. If it is changed to the inventory, definitely IAS 2 will apply. Okay, transfer from owner occupied to means this is nothing but the reversal of this. Okay, transfer from, this is nothing but the reversal of this. What it says, normal accounting means normal accounting as per IAS 16 is costless depreciation. Is it right? On adopting the fair value, there is normally, see, when you talk about fair value, definitely there will be increase in value. Okay, there will be increase in value. This has to be recognized where? This has to be recognized in OCI. Yeah? And whatever is have the excess, it has to be transferred to in equity. Is it? If fair value causes a decrease in value, then it has to be charged to the profit. If it is a increase in fair value, OCI and statement of other components of equity. If it is decrease in fair value, you have to decrease it from the profits, and any specific reserves are there, then you have to deduct it from those reserves. Any change in the carrying amount should be recognized in profit and loss. Is it? Now, they have given a small illustration. Okay, illustration is also important. Lavender owner's property, which is rent out to some of its employees. The property purchased for 30 million on 1/1/2002. How much you have bought it? You have bought it for 30 million. For useful life of how many years? 30 million on January 1st, and its useful life is how much? It is for how many years? It is for 30 years. And on 1st of January 2007, is it? What is the market value? Market value is 50 million, and remaining useful life is remained unchanged. See, 2002, 2, 3, 4, 5, 6. Okay, means how many years are there? 5 years. Is it 5 years? See, that's what they have done. They are done very simply. Is it? Property that is rented out to the employees, the useful life remain unchanged. The management wish to measure properties at fair value where there is allowed by account. This is allowed by account. What is the requirement? how should the property be treated in the financial? See, property that is rented out to employees is deemed to be what? Is deemed to be owner occupied. You have very clear message is there that lavender owns a property. If it is means it is a owner occupied, therefore cannot be classified as a investment property. Very, very clear. Is it? If it is owner occupied or owns a property to its employees, then it is not going to be investment property. Management wish to measure at fair value. So lavender adopts which model? Fair value model in IAS 16. Fine. Now, what is a very simple? What they say? See, they have from 1/1/2002 to 1/1/2007. How many years? 5 years. Is it right? 30 is there. 30 into 5 by 30. Okay? 5 by 30. Fine. How much is there? 5 is there? Minus 30 minus 30 into 5 by 30. It comes to how much? 30 minus 5. It comes to 25. Okay? It comes to 25 million. This is the carrying amount. Okay? This is the carrying amount as on 1/1/2007. Okay? Now they have revalued it. Is it right? They have revalued it. How much they have revalued it? There is a fair value revaluation. Is it right? The fair value as on 1/1/2007. Is it right? How much? It is 50 million. Is it right? It is 50 million. What is the carrying amount? Carrying amount is how much? Carrying amount is how much? Carrying amount is 25 million. Is it right? Carrying amount is 25 million. How much is the gain? The gain is 25 million. Is it right? How much is the gain? It has to be recognized in other comprehensive income in the profit and loss account. Fine. Now, from 1/1/2007 onwards, that my handwriting is not that much good, but I will write everything what I am speaking. Okay. From 1/1/2007 onwards, what is the depreciation? Depreciation will be 25 million. Is it right? Sorry, this is not. What is the fair value? Fair value is 50 million. Is it right? And how many years are left over? Left over is how much? 25 years. In depreciation will be how much? Depreciation will be 2 million. Is it right? Depreciation will be 2 million. Now, this is how much is the carrying amount? Carrying amount is 50 million minus current year depreciation is 2 million. It comes to how much? It comes to 48 million. Understand? See, these are the very simple, basic concepts which you have to. If you understand, I will say it's a piece of cake. It's not difficult at all. Only thing is you have to understand how best we can apply the thing. Please share my channel, subscribe to my channel, share my channel, watch till the end and like the any comments, please post it. I really appreciate that. The subscribers are increasing, number of people who are accessing, viewing these channels are increasing, and I'm very, very happy about that. Okay? Are you clear about this? This is the way we have to work it. Another one, what it says. ABC owns a building that is used as its head office. On 1st January, the building which was measured under the cost model and carrying amount is how much? 1/1/2001. Is it right? How much is there? 500. On this day, the fair value of the building is how much? On this date, this is the carrying amount. Okay, this is the carrying amount. Now, what is the fair value on 1/1/2001? Fair value is how much? Fair value is 600. Fine. Fair value is how much? Fair value is 600. Now, ABC vacated the premises. However, the director decided to keep the building in order to rent it for to tenants, means other people. Is it right? To the other people, and to potentially benefit the increase in property prices. Is it right? Is it right? If that is the case, we have to think. We are getting a rental, and we are talking in terms of increase in prices. It means IAS 40. ABC measures investment at a fair value. On 31st December 2001, the value is how much? 625. Yeah, 31st December 2001, how much the value is? How much? 625. Very simple, very specific also. Okay. When a building was owner occupied, when it is owner occupied, it has to be treated as property, plant and equipment, IAS 16. From 1st January, the intentions has been changed. From 1st January, the property was held to earn what? Rental income and capital appreciation. In the intention, the purpose has been changed. So it has to be classified as investment property. Fine, investment property. If as per IAS 40, if owner occupied becomes investment property, then what we have to use? We have to use fair value. Then the revaluation will occur as per the things. What will happen? See the thing. 1/1/2001, is it right? How much is there? Fair value is how much? Fair value is 600,000. Is it right? Now 1/1/2001, carrying amount will be how much? Carrying amount is 500. Okay, carrying amount is 500. Difference of how much? Difference of 1,000. Is it right? This is OCI, other comprehensive income. Is it right? OCI and reserves to the equity. Fine. Now, what happened? At the year end, is it right? At the year end, they have a revaluation. Is it right? At the year end, they have a revaluation. When they have a revaluation, what happens? How much is the revaluation? This is it fine? At the year end, how much is the 31/12/2000? 31/12/2001. Okay. See, when you are doing the fair value, keep it in mind. When you are doing the fair value, we are not supposed to calculate depreciation. This is the return rule. Is it right? This is the return rule. How much is there? See the things. It comes to how much? 625. 1/1/2001 amount is how much? 600. Again there is a gain. Is it right? Again there is a gain of how much? $25,000. The rule says that investment properties held at fair values are not depreciated. Fine. What are the disclosures we have to do? We have to let them know whether it is on the basis of cost or fair value. Is it right? What are the amounts should be recognized? What amount have been recognized in profit or loss for the period? We have to do reconciliation. That is as simple as that. Beginning and end of the period amounts to know whether we have got gain or loss. The fair value of investment if the entity use the cost model. These are the things which makes the concept very clear. A simple way of they have made how we have to do reconciliation. Is it right? Fair value of investment properties is highly relevant. Is it right? We have to reconcile it. Cost at the beginning of the year, additions, reclassification and disposals, and at the end of the year you will get this much. And accumulated depreciation, beginning of the year debt charge, impairment charge, classification, disposal, will get at there. What is the net carrying amount we have to take into consideration? Is that this is the most significant aspect which we have to take into that which you have to take into as a 153 and 71. 153 minus 71 equal to how much? Now you have a you see, only thing is we are consolidating the knowledge what we have done in F7 financial reporting. Estimated value is, they gave you a small example, is it? How, see what it says, the estimated value of investment is 210. This fair value has determined appropriate rental yield, rentals earned by the investment property. Evaluation has not been performed by the, for this, see, disclosures are important. See, every sentence, every paragraph is important. Why I am going through each and every paragraph, everything which I am explaining, just to, if I don't do this, if I skip one paragraph now, next paragraph we can't understand. Okay, so that you should have to be very clear. Investment can determine the carrying amount. Investment property is below the fair value. In other words, the financial statements of the entity understate its, means you have to make sure that what is the carrying amount of the investment property. We have to make sure that what is the carrying amount and what is the fair value. It happens in both the way. Sometimes carrying amount will be more, fair value will be less. Sometimes fair value will be more, carrying amount will be less. Is it? We have, that's what they say. We have to disclose this. It enhances the ability of investors to compare this entity with entities, because we have to be very transparent. Okay, so that we can make the stakeholders, investors can compare whether you are doing in a right way or not. The disclosures also inform investors that the fair value of the investment property using a judgmental methodology. Is that? This is where the most important factor that comes into picture when you are doing this. Fine? Now, coming back to this, test your understanding. The directors are considering purchasing investment property for the first time in order to benefit from the, see, what I suggest is you divide everything into small sentences. See, these are the techniques. In examination also, make small sentences. See, what is the advantage you will have if you do small sentences? We get good amount of content to put the things in order. Property prices are rising, and the directors believe that the substantial returns could be made from these investments. Good. Next, the directors are aware that IAS 40 offers entity a choice in how investment property is measured after initial recognition. However, they divide the things. However, they are unsure of the factors that should be considered when selecting a measurement basis. With reference to investment properties, discuss the factors. Discuss the factors that should be considered when preparers of finance are required to measure. Your answer should be referred to what? Conceptual framework. When you say I am putting it in a very brief. What is the objective? First, we have to see objective of financial reporting. Is it right? Objective of financial reporting is nothing but to provide information to the users of financial statements. Is it right? Means to provide the to whom? To all the stakeholders and investors in particular. Is it right? And when selecting a measurement base, you have to the information needs of users, what information the users need. That's very important. Is it right? You see, users perspective with reference to information is very important. See, what you know, you should not give. What people need, you have to give. Okay. Next, when you are doing this, see, when you are seeing that, what are the factors? Consider preparedness. Nothing is there, is it right? Here, which factors you have to take? We have to take qualitative factors. This type of question they will ask, and they will ask this type of question for how many marks? For 3 marks. See, you should be very, very clear. Is it relevant, reliable, timely, understandable? Is it right, faithfully? Is it right, comparability, consistency? Is that what happens? See the thing. Whenever you are doing this, there should be a comparability. What they say, they have mentioned here very simple. They have mentioned here that the direct property benefit of property prices are rising, substantial returns from the investment, aware of the choice, how investment property is measured. They are unsure of the factor that should be considered while selecting a measurement basis. You should have comparability, right? You have to compare it year to year. You have to comparability with the competitors, with the markets. Is it right? The first thing, there should be relevance. Is it right? That's most important thing is it should be relevant. It talks about what? It has to be relevant with the fair value over the time. See, when you are talking about the fair value, what is the conditions of fair value? The conditions of fair value that it has to be done annually. Is it right? It has to be done. Is it right? It has to be done annually. That's the most important. What is the relevance? Relevance that there should be a future, more relevant information about what is the future cash flows. Is that what is the future? See, this is all we can write in our own sentences. Okay, we can put it in our own sentences. Now, what is the most important is faithful representation. See, that's very, very simple, very, very clear. Whenever we are making a submission, is it right? The submission should be very, very faithful. You should not mislead. Okay, you should not mislead the things. When you are doing the thing, definitely see, when you are making a revaluation, is it you are revaluing the properties, something will happen. There is not like that you will have 100% accuracy. There will be something plus or minus. Is it right? There will be something plus or minus. Then what you have to do? There are different levels. Is it right? You have level 2 inputs are there. Level 3 inputs are there. Is it right? What are the level 2 inputs? Level 2 inputs are the quoted prices with respect to similar. Is that with respect to similar assets? Is that quoted prices with respect to similar assets in the active market? What is level 3? When you are talking about the level 3, we have to take into consideration that unobservable. Is that unobservable inputs? See, this is happens when we are making an assessment. It is nothing like 100%. It will be specific. There will be a margin of error will be there, but the margin of error should be as minimum as possible. Here you can write some more things as per your requirements. Okay, you can write some more things. What we are doing, we are talking in terms of with respect to conceptual frame. Okay, now what we have done, with respect to 1 minute. We have done with respect to IAS 23, okay, IAS 23 borrowing cost, and we have done with respect to IAS 40 investment property. Okay, IAS 40 investment property. I'll just make sure that we will do this and we'll solve. What is the next one? We are talking about, see, what we have to do. We have done IAS 23, we have done IAS 40, and we will do IAS 38. what is the intangible assets. Okay, IAS 38 talks about intangible asset. A intangible is defined as an identifiable non-monetary asset without physical substance. The identifiable non-monetary assets. Non-monetary assets means you have the clear understanding what are the monetary assets and non-monetary assets. Monetary assets are the current assets, is it right? Mostly the thing. Now, what are the examples? Goodwill in business combination. See, one thing is very clear. I will make it very in the beginning only. Internally, is it right? Internally generated goodwill will not be recognized. Is that will not be recognized. Very simple. You have a goodwill acquired in the business combination, computer software, patents, rights, copyrights. Now you have that Netflix, is it right? Netflix, motion picture films, customer list. That's very important, is it? Database. People are only working on what? People are only working on database. Is it right? People are only working on the database. Subscribers, that's very important. Okay, mortgage servicing rights, licenses, quotas, franchises, customers and suppliers relationship and marketing rights. These are the examples which we all know. Okay, how it has to be recognized, is it? For the see, now you can have various recognitions. What is the definition? What is the recognition criteria, valuation once, then they will give the concept, then they give the application, then what are the disclosures. Okay, this flow will be there in all the cases. An entity should recognize intangible assets if the asset is identifiable, if it is you have a control on by the entity, it will generate future economic benefits, and more importantly, the cost of the asset can be measured reliably. An intangible asset is identified if what is the intangible, the core concept, it's separable, capable of being separated and sold, transferred, licensed, rented, exchanged individually or part as a package. Means it has to be separate, like a license, is it right? You have all the things which has been mentioned here, is it right? License, quotas, franchises, is it? You have marketing rights for specific regions, is it right? For specific regions, if that is the case, it is going to be called as an intangible. It arises from a contractual, is it right? Or legal rights. Whether it is, regardless whether the rights are transferable or separable from the entity, or see it arises from what? It arises from a contractual or legal rights. This is where we are going to understand. If the tangible assets, is right, if the tangible asset does not meet the recognition criteria, expenditure should be charged to profit and loss account. If it is not meeting the criteria, definitely we should not capitalize it. We should not show under the category of intangible asset. Instead of that, what we have to do, we have to convert it into, you have to show it, reflect it into profit and loss account. Once expenditure has been charged, it cannot be capitalized. Very important point. Wherever I am putting it as a star and wherever I am putting it as in a purple, it is very important. Okay, means once expenditure is charged to the profit and loss account, it cannot be as simple as that. You cannot make a reversal for that. Note what it says. It says that accounting treatment of goodwill, if it is coming from a business combination, then we have to deal with IFRS 3. We will cover this IFRS 3 at a later stage, business combinations. Okay, initial recognition should be at cost. Subsequent recognition what is a either it will the cost model or it will be on the revaluation model. Is that when we the same rule, the things are not changing. The cost model measures cost less accumulated amortization. Here we are not getting depreciation. Is it right? We are getting amortization. What is when we do amortization? We are when we have a definite life. Is it right? You have a finite life. Is that you have a finite life? When it is finite life, it is amortization. Is it? What is the amortization? Reduction in value of the asset. Okay. What is the amount? You know these things. Is it right? You are at this level. Just I want to reconfirm, and you have a just a recap. That's all. Okay. It is for finite life we use amortization, and for infinite life, is it right? We use the impairment. Impairment is nothing but market value is less than the book value. Okay. This is the cost model. What is the revaluation model? It is the measure of the asset at fair value less, is it? Here it is cost less accumulated amortization or impairment. Here it is fair value less. Here it is cost less. Here it is fair value less. See, when you are doing, see, these are the basic things. The revaluation can only be adopted if it is have a reference to the active market. Means when there is the active market means there is demand for that product and people are willing to buy and sell. They are willing buyers and sellers at all times. Then only we can work it on the revaluation model. Okay. What are the active markets? They are very rare. Is it right? You're talking about quota, stock exchange seats. Is it? If you want stock exchange seats, definitely it's a very active markets. Is that active markets unlikely to exist in terms of brands, newspapers, music, all those things. The revaluation should be made sufficiently regularity. Means about very simple. When you are doing the revaluation, it has to be done on the regular basis. Is it? If there are any gains on revaluation or measurement, it has to be same as revaluation of tangible assets. Gains and losses on remeasurement to value are accounted for in the same way as revaluation. With respect to amortization, finite life, is it? A asset must assess whether the useful life of the intangible asset is finite or indefinite. If an asset with finite useful life must be amortized on a systematic basis. An asset with an indefinite useful life, where there is no foreseeable future, then it has to be amortized to the period which is expected to generate cash flow. It should not be amortized, but it should have an impairment. If it is an indefinite useful life, it is an impairment. If it is a finite useful life, it should be amortized. Okay, this one I'm just putting it on a as an indefinite useful life with no foreseeable future. We have to think in terms of what? We have to think in terms of future. Okay. What it says, test your innovate, is it? Test your understanding with respect to innovate. Very simple. They will just mention, ask you on the 10 years ago, Innovate developed a video game called as Our Sports. They have sold 10 million copies around the world and was extremely profitable. Due to its proper popularity, Innovate releases new sports game every year. This game continues to be bestseller. Fine. Now, what sorry, what terms it as intangible asset? Okay, when it is going to be recognized. The directors have produced cash flow projections That's what it says. Future cash flow projection for the next 5 years. Based on this projection, they valued it brand at how much? 20 million, and wish to recognize this as on 30th September. See, this is internally generated goodwill. Very simple, should not be recognized. Is it? Cannot be recognized. Very straightforward. That happens here. The 10 years ago, they have developed video game. They have sold 10 million copies, extremely profitable. They release the things every year. The game continued to be bestseller. All are internally. The producer produced cash flow statements. Okay, these conditions are meeting. Okay, based on this projection, they have a brand value of 20 million. Fine, internally generated, not recognized. On 30th September, Innovate paid. This is very important. You have to purchase, paid for the rights of the pets and me after the original developer went into administration. If it is paid, is it right? What we have to do, it can be measured reliably. Is it? It can be measured reliably. Fine. And as simple as it is externally. Is it right? It is not internally. It is externally. Is it? Now, what we will use? We will use amortization, or we will use the impairment. Okay, we will use the amortization, or we use the they also paid 1 million for the rights of video games after the original development went into place. Is it? Because as simple as that. Is it? Because what happens? It has a finite life. Is it right? You are saying why we are coming to a conclusion of finite life? We should give a reason for that. Is it right? Every year. Is it? It is a finite life. Every year means at the end of the year the things will be outdated and you have to come with a new, because is it right? It is a finite life. Is it right? Because it is a finite life, what you are doing? We are going to amortize. Is it? Means you have to be very specific. See, whenever you are arguing a point, you have to argue the point with substance, with some logic, with some justifications. Okay? In the examination, you have to be very specific about these things. Fine? Okay. John statement is a we will okay, we'll do this and we'll stop here. Okay? Research and development is another new topic. Okay, John's statement of financial position includes an intangible asset. The asset is a portfolio of individual customers acquired from a similar businesses which gone into liquidation 2 years ago. The accountant asked the finance director why the asset has not been amortized in the current period. The finance director replied that they have changed the assessment of the useful life of these intangible assets from finite to indefinite. See, they say that they have changed it from finite to indefinite. They don't have a clarity as such. Is it right? They don't have the basis. They justified this on the ground that it is impossible to have a foreseeable length of this intangible useful life due to a number of factors: technological evolution, changing of consumer behavior. Is it right? Now, when we do the things, is it right? what it says, if we are saying that IAS 38 intangible asset, has an indefinite use only if there is a no unforeseeable feature. Is it right? When we say it is when we say it is going to be indefinite life, is it right? Indefinite life. Is it only if there is no foreseeable limit? Is it right? No foreseeable limit. What it says? It says that the asset of a portfolio of customers acquired for a similar business liquidation. The accountant and finance director have asked the finance director. Asset has not been amortized in the current period. The finance director replied that they changed the assessment of the useful life of intangible asset from finite to indefinite. Means they have changed from finite to indefinite. If it is finite, it has to be amortized. Okay. If it is indefinite, it has to be a impairment. Is it right? Now see what it says, individual customer. See, when you are talking about the asset of the portfolio, impossible to see the foresee the length of entire asset due to number of factors such as technological evolution, changing. See, technological evolution is a technological evolution, is a behavior, very simple. It is time based, it is finite. Is it right? It is finite, very simple. We cannot say that they means they have a time limit. We have to make this judgment. Okay, this is where the difference between F7 financial reporting and strategic SBR. Okay, in financial reporting they will never ask this. In SBR they will ask your judgments. Is it right? In SBR they will ask based on your assumptions. Is it? You have to give justification why we have to take it as a finite, why we should not take it as finite, because it is technological evolution, it is changing customer behavior, it is talking about the individual customers. Is it? See, once we put all the things into consideration, what we have to do, we have to make a justification. It is as per the intangible assets IAS 33 and as per IFRS standards, whether it has to be treated as a intangible asset. If it is going to be treated as intangible asset, whether it has to be amortized, okay, whether it has to be amortized or it has to be have a impairment. For this they will give you marks. Okay, for this they will give you marks. Fine. Today this is what is it. Today what we have done three things. One, we have done IAS 23, we have done IAS 40, and we have done IAS 38. Okay. Again, see. Okay. Next, in the next session, we are going to work out on the other regarding the research and development, and we will work it out on impairment and IFRS 5. Okay. We will make sure that how the things will work. I told you in the beginning that we will have this session, this chapter into 3 different sessions as such. Okay. Thank you so much. So again I will say subscribe to my channel, share this channel, watch till the end, and if you find really value added, like this channel. Okay. Any feedback, please post it. I am very much looking forward to read the comments and feedback. Thank you so much.